Mortgage Guy here. Wanted to shoot a quick video with my take on Dave Ramsey's home buying advice. Matt the Mortgage Guy here. Wanted to shoot a quick video on Dave Ramsey's home buying advice, where I might differ. First and foremost, I want to say I love Dave Ramsey. He gives a lot of good advice. I've listened to thousands of hours of his podcasts. I've read tons of his books, and he gives really good personal finance advice. I just so happen to not agree with all the home buying advice he has, which is fine. And that's what this video is about, is that his advice, albeit great, he gives a certain advice to the masses. And like I've said in previous videos, I'll say in future videos, there's no one-size-fits-all general advising that you can do to everybody that's going to work for everybody. So the inspiration for this video is I had a great couple in last week. They followed Dave Ramsey and have done a lot of good things. They've paid off all their debt. They have no debt at all and closed all their cards. Within 6 to 9 months, you'll have no credit score. There's nothing to base it on. You have no credit. And Dave Ramsey will say, well, don't worry, if you still want to buy a house, you can do it. Because without a credit score, there's plenty of mortgage companies that will work with you. You'll still be able to finance a house, no problem. Well, it's true that some mortgage companies will work with you. And as an independent broker, I can look at all of them and find the ones that do, and find of those who do it, which the best terms will be. But what happens is, when there's no credit score to go off of and all these guidelines are written off credit score, they'll manually underwrite your file. Dave Ramsey knows that and has said that. But what happens is you get worse terms. They have no bucket to place you in credit risk wise. And so they say, no problem, we'll manually underwrite you. If you're getting a 1% higher interest rate on a mortgage, the average home in California or Sacramento County that's in the mid 300s, we're talking about $300 a month in increased payment for a higher interest rate. So this specific piece of advice that Dave Ramsey had, my client said, well, what if we had a secured credit card or went and bought $1,200 couches and paid those off over the next 12 months, making monthly payments to establish credit so we can get a lot better mortgage? I agree with that. I think that's a really good idea. And these folks who are super responsible will do that, pay it off, and they can close the accounts after that, after they've established a mortgage, and I'm fine with that. Go back to how they're doing things now. But to force yourself to do a mortgage with no credit scores, non-traditional credit, and get worse terms, I feel like I don't agree with that advice by Dave Ramsey, because the terms are that much different. 1% higher in interest rate is going to equal hundreds of dollars per month, thousands of dollars over the life of the loan. So in that scenario, have a little bit of credit established so you get a better mortgage. That's my advice. Had a great couple in here, a veteran who served our country, his great wife, smart people, super financially responsible. I don't think getting a secured credit card for $500 or charging something on an account, them knowing what they're doing to establish credit, is bad. I think it's a good idea. It's strategic. And then they can close it. And they can have no open credit lines and still follow Dave Ramsey's principles. Okay? That's how I feel on that. Another thing, and I listened to some more Dave Ramsey recently because I used to listen to it a ton, and I agree with a lot of it, a lot of great advice. The housing stuff, it just doesn't pertain to everybody. The advice on a 15-year mortgage with your payment equating to 25% of your take-home pay, it just don't work in California, buddy. I'm sorry to break it to you, Dave. And for some people it does. For some people who are advanced in their careers, making a really good living, they can make that work. But I work with a lot of first-time buyers who are excited, they're responsible, and they're not making themselves house poor and buying too much house. But a 30-year fixed-rate mortgage is the better option for them. And I'll, agree to disagree with people that'll tell me that the 15-year is better. Sure, you save a bunch of interest, and sure, if you're able to, it's great, but it's not for everybody. And to buy a house in California with your payment equaling 25% of your take-home pay on a 15-year mortgage, we do it all the time where it equates to it on a 30-year, but that higher payment that comes with a shorter term, the 15-year, it's just not gonna pencil. folks that are starting out and they're, a married couple and they're only 2 or 3 years into their career and, combined they make $70,000 a year. They're doing great. On a 30-year mortgage, they're going to have a comfortable payment that's equal to what their rent is. But to tell them that, we're going to take their $6,000 a month, maybe it's $5,000 take home, divide that by 4 to get 25% of your take home pay. Now we want $1,250 to be your mortgage payment. We want that to be equal to, or we want that to be able to be a 15-year term, $1,250 mortgage payment. I'm sorry, there's nothing in Sacramento that you can buy for $125,000 that makes that equation work. And the truth of the matter is these folks are renting for $2,100 a month. If I get them into a 30-year where they're paying $1,800 a month, that's a good, smart choice. We don't have to tell them to wait. And honestly, they'll be waiting for 15 years until they can go up enough on the income side and be in a position to, do like some of this advice says. So anyhow, before I get too long-winded, I just want to say in no way is this disparaging to Dave Ramsey. He gives a lot of good advice. Specifically when it comes to mortgage and mortgage financing, I think that some of that advice is not going to be one size fits all. There's going to be certain circumstances where certain folks are going to want a credit score to get a better mortgage, and they're going to be fine in a 30-year fixed rate mortgage. Maybe they go on their careers and they make double 5 to 7 years later, refinance into a 15-year. I'm all for it. So that's my take. Any questions at all, please feel free to reach out. Matt the Mortgage Guy. Until next time.